In the previous section, we explored a framework suggesting that silver's recent behavior may reflect a deeper shift in the global credit environment. If that framework is correct, we should begin to observe real-world signals emerging across markets. And over the past year, several developments have started drawing attention, not dramatic headlines, but as structural indicators that may support the idea of a gradual transition. One of the most widely discussed developments in the silver market is the ongoing supply deficit. According to industry estimates compiled by the Silver Institute, global silver demand has exceeded supply for several consecutive years. In 2022, the market recorded a deficit of roughly 237 million ounces. In 2023, the deficit remained significant at approximately 180 million ounces, and projections for 2024 suggest another deficit well above 200 million ounces. To put this into perspective, these shortages represent nearly 20% of annual global mine production. Under normal commodity conditions, deficits of this magnitude would typically push prices sharply higher. Yet silver prices have risen only gradually. This disconnect is one reason analysts have begun looking beyond traditional supply-demand explanations. A second development is the long-term decline in financial silver inventories. During the early 2000s, large quantities of silver were still held in financial reserve form. But over the past 2 decades, much of that metal has been absorbed into industrial supply chains. Solar panels, electronics, medical equipment. As a result, silver held specifically for monetary or financial purposes has declined significantly. For example, registered silver inventories on major exchanges have periodically fallen to levels representing only a small fraction of annual global demand. In practical terms, this means the market may have less readily available metal than many investors assume. And if financial demand begins increasing, inventory rebuilding could require significant physical accumulation. Another key factor supporting the deficit environment is rapidly growing industrial demand. Silver plays a critical role in several modern technologies, most notably solar energy. Photovoltaic manufacturing has become one of the largest sources of silver consumption. Industry estimates suggest that the solar-related demand has more than doubled over the past decade. Today, solar manufacturing alone accounts for roughly 15% of global silver demand. Electronics, electric vehicles, and semiconductor manufacturing also contribute to rising usage. Unlike some commodities, silver demand in these sectors is relatively difficult to substitute, which means a structural demand growth may continue even during periods of economic slowdown. But perhaps the most important signal comes from outside the commodity market itself. It comes from the global credit system. Over the past 2 decades, U.S. federal debt has increased dramatically. In the year 2000, total U.S. government debt stood at roughly $5 trillion. Today, that figure exceeds $34 trillion. As a share of GDP, U.S. federal debt has risen from about 55% to well over 120%. At the same time, interest rates have entered a higher phase. Higher borrowing costs change the dynamics of global liquidity. When debt levels rise faster than economic output, questions sometimes emerge about long-term currency stability. Historically, periods of monetary uncertainty have often coincided with renewed interest in precious metals. Taken individually, each of these developments can be explained within normal market cycles. Industrial demand can grow, inventories can fluctuate, government debt can expand. But when several of these forces begin aligning at the same time, markets sometimes enter a different phase. A phase in which assets previously treated as commodities begin regaining financial relevance. If that process is beginning in the silver market, price movements may represent the early stages of inventory rebuilding, not merely industrial consumption. Ultimately, the key issue may not be whether silver is simply an industrial metal. The deeper question is how financial markets choose to classify it. For decades, silver has been treated primarily as a commodity. But if credit conditions continue to evolve, investors may gradually begin to reassess its role within the financial system. And if that reassessment unfolds, the rebuilding of monetary inventories could become one of the most important drivers of the silver market in the years ahead. So the original question remains, why hasn't silver already moved dramatically higher despite years of supply deficits? Perhaps the answer is that markets are only beginning to reassess what silver represents. And if that reassessment continues, the adjustment process may take years rather than months.